So good evening and welcome to week 2. It's a very pretty day here in Virginia, and we are starting to see some cool mornings. So not sure where you are, but getting close to the first frost here in Virginia. So could someone verify that you're hearing me okay and seeing the video okay? Thank you.
Yes.
All right, thank you so much. Mary Ann gave me a thumbs up, so we are good. So I do want to say thank you guys for getting off to a fantastic start with week 1. This is a really large class. We have more than 50 students, and I'm sure you probably noticed that when you were doing your discussion postings, a lot of classmates that you can respond to. But I think we only had 1 or 2 individuals that didn't participate. So that is phenomenal that we had everybody jumping in and completing the discussion boards and working on the assignments for week 1. So thank you very much. That makes my life a lot easier when everybody is out there working hard and participating in the class. What my plans are tonight is to go over our topic this week, which is budgeting. And I'll just take a moment at the end of the class and make sure we know what's on the radar for this week. Nothing really surprising from what you've been doing. So I will touch on that towards the end of the class. Are there any questions related to week 1 or to the actual course requirements that you might have on Canvas?
I do have a quick question on the posting, Professor.
Okay.
I know that we do require to do posting before Wednesday. Would it be okay to post the first one on Monday and then the rest like Tuesday
Sure.
and Wednesday? It has to be
Sure.
Wednesday and then Thursday, or can you do the first 3 days of the week?
Do it any way you want. I don't think there's going to be a problem with getting classmates to respond before later in the week because we have such a large class. So you can really do those postings at any time you want. If you want to do it earlier in the week, that's fine.
Awesome. Thank you. Thank you.
Okay.
It's just that this busy schedule I want to get into on time, but I'm like, I have more time in the first three days of the week. I want to make sure. Thank you.
Perfectly fine. Okay, any other questions or comments you might have? Okay,
I have a quick question. I don't know if you're going to go over the budgeting and service companies, or you won't go over.
I'll talk a little bit about budgeting and service companies. So if I get towards the end of the session and I forget to do that, Emelina, just jump in and remind me. So,
Okay.
Okay. All right, so I will go ahead then and get started on our topic this week. So again, we are going to be looking at budgeting, and many times when we think about budgeting in a business, we really tend to think of it as something that's not that important. Have any of you ever been involved in preparing a budget for a company? And if so, what did you find to be the biggest challenges in that process? So no one's actually participated in preparing a budget. Well, what about a personal budget? How many of you do personal budgets? I hope Tammy says she does. So we get a few hands. So at least you're in the habit of doing budgets. And it's very important that we understand as business professionals that the budget process in a business carries a very important purpose in managing and working through a business to achieve what are your short-term and your long-term goals. So it's not something we should take lightly. And I tell my students, or I used to tell my students, that a budget was like a roadmap. So some of you guys may not know what a roadmap is. I've been around quite a while, so I know what a roadmap is. It was something that gets you or tells you how to get from point A to point B. Now you have GPS, or you might have some type of app that tells you the same thing, but that's really what a budget is. It tells you how to get from where you are and where you want to be. So I'm here now, and in the end of a year, I want to have $1 million in the bank. So how am I going to do that? How am I going to get here to there in 12 months? So a budget is really what drives your performance in an organization and helping you achieve those goals. So the skills that you get from preparing a budget are going to be very valuable to you in the workplace. I enjoy the budgeting process and working with staff in doing budgets. Now in healthcare, however, we certainly have individuals that are quite fluent and enjoy the budgeting process, but then again, we have other managers who aren't so enthusiastic about that process. So for example, nurses really aren't that enthusiastic about doing budgets, but at the same time, that's probably one area that requires quite a bit of preparation and focus, because it is a significant part of your cost in a healthcare facility. So many times when you're doing budgeting or you're facilitating that process, it might involve training those individuals and educating them on how to appropriately do a budget and showing them what benefits they get from successfully completing that document. So what I'm going to do is I'm going to go through and we're going to talk about some of the concepts related to an actual budget. And then we'll dig in a little bit deeper and we'll talk about the process by which we do a budget. I'll share with you my experiences, and you are certainly welcome to share with me your experiences. We're going to start out by looking at it from a product or manufacturing standpoint, as if we were a manufacturer. And then we'll talk a little bit about what would be different with that process if instead of manufacturing a product, we were selling a product or we were providing a service. How would the budgeting process look different? So when you think about healthcare, for example, we're providing a service. So the way that we budget in healthcare is going to be a lot different than how we budget in a factory. So we'll talk a little bit about that. So we know that budgeting serves some very important purposes. As I mentioned earlier, it helps you develop a strategic plan or a timeline to get you from one point to another point. And budgeting can be prepared for different periods of time. You could do a monthly budget, you could do an annual budget, you could do a 5-year budget. We see all of those different types of budgets in organizations, and each one of those is done for different reasons. We're going to focus on an annual budget, that which we do for a upcoming 12-month period. That is also called an operating budget. So the term operating refers to budgeting of your revenue and your expenses for the upcoming 12 months. So that's where our focus is going to be. So we have to have budgets in order to measure, evaluate, and control our performance. So we can't just throw a budget together and say, okay, here's what we got. Let's lay it here and leave it for the next 12 months. No, a budget has to be a tool that is actively managed in an organization. And if there are differences between the budgeting numbers and the actual numbers, we have to address those items, figure out what's causing those variances, and if necessary, how we're going to fix them. So this is a very engaging and active process. In most workplaces today, we see budgeting take place as a participative activity. And all that means simply is, instead of one person or a small number of people preparing the budgets for every single department and then handing them to those managers, now we see managers themselves preparing their budget for their respective departments and then sharing them with the budgeting coordinators who compile them into one big document. So when we allow our managers, our employees to participate in this process, that's called participative budgeting. And you may know, you may not, but many, many decades ago, we didn't have that. We had top-down budgeting where the budgets came from upper management, and that was your budget for the year. So participative budgeting brings a lot of benefits. More specifically, if the managers of your departments are preparing their own budgets, who knows that department any better than that manager? So getting that perspective and understanding why we budget what we budget and what some of our restrictions or opportunities might be in doing a budget would fall on that manager. So it is a great tool to have as a manager to have that skill. So we typically start out a budgeting process in an organization by having one big meeting where we bring all of our managers together in one room. And we do that somewhat as a brainstorming session where we talk about what are some of the challenges we are facing or currently in our organization and how we're gonna manage that going forward, and then start to set some of our targets as an organization for the next 12 months. And the reason we do that is if we know what we're looking at doing as an organization, then managers can better prepare their component of that budget. And many times when we have multiple departments, there can be changes in one department budget that affects another department budget. So if we don't have participative budgeting and we don't share that information, we can end up with bad budgets. For example, in a hospital, you have your surgery department budget. So they're budgeting for the number of surgery cases that you have. So let's say that surgery manager decides to budget for a 10% increase in surgeries. Well, that certainly would affect the lab department. It would affect the radiology department. It might affect the environmental services department. So if those managers do not know that those changes are being made in one department that's going to affect their department, then they're not going to adjust for that in their budget. So we have to have a good system by which we share information so that we can make those necessary adjustments that aren't necessarily just in our department, that might be affecting multiple departments. When we do budgets, we do have to be careful in how we design them. If budgets are set too tight, they do a lot more damage than they help. You know, it's great that you want to do a good job and impress those people that you work for, but when you start over-promising in your budget and knowing that you'll never achieve that, it's not a good thing, just for you, but also for your employees, because when your employees realize that they're never going to reach a target, then that's really more demotivating than it is motivating. So it can have negative effects on your employees. I always tell people it's better to under-promise and over-provide than it is to over-promise and under-provide. So set your budget realistically, knowing that your goals that you have are attainable, with the drive to try and exceed those, to do better than what you budgeted. That's a lot easier to manage, and that's a lot easier to get your employees on board to do that. Budgets can also be set too loosely. So if you don't budget for a level that is attainable by performing at a reasonable level, then your employees are going to respond to whatever that level is. So if you have employees that could produce 12 units a day of a product and you only budget for 8, you know, that's going to affect the performance of those employees, and you're going to lose productivity. You also have to make sure your goals that you set in your departments align with your company's goals. So you don't want to do anything counterproductive or counteractive in terms of where the organization wants to go as a whole. we have to, again, make sure those goals are attainable. And many times managers themselves will meet with their employees that work under them, what we call line or staff employees, and get their feedback on what they're looking at doing, what changes are they looking at making in the department going forward. And that is fantastic, because if you can get your employees to buy into those goals and targets from day one, then they're vested in that. They are involved in that, they're committed to that, and they're more likely to strive to meet those targets and receive the reward associated with that, which many times is a bonus, right? So it's good to have that. One term you have to deal with in budgeting is what we call budget slack or budgetary slack. And that simply refers to the fact that when managers are doing their budget, they will usually allow for a little bit of cushion, so to speak, between their budgets and where they actually can perform to provide some protection there. So for example, they might say, well, you know, I could get by with 5 employees in my department, but I'm going to budget for 6. So that difference is what we call budgetary slack or padding the budget. Is that a bad thing? Not necessarily, because if you prepare your budget for 6 employees, knowing that you only need 5, and you submit that budget for review, and then your accounting or finance department comes back and says, okay, you've got to cut out 5% of your budget. You've got to reduce it by 5% to help us meet our goal. Well, if you only have 5 employees in that budget and you need 5, where are you going to cut? So if you got a little bit of slack built into that budget, you might have a little room there where you can make up that additional 5% without creating any damage to the actual performance of your department. So I would say that good managers that have good budgeting skills, it's okay to pad your budget, you know, to a degree. Your senior managers may identify that and ask you to take it out. But again, if you've got the cushion built in there, whereas someone doesn't, then you may be able to respond to those types of reductions a lot easier than your colleagues. All right, budgeting systems. So I can remember the days, and you guys aren't as old as I am, but I can remember the days where every manager did their own budgets, and then they submitted them on paper to me, the accounting department, and we had to take every paper and put them into a spreadsheet and create the master budget. So imagine having 28 departments and trying to put all that into a spreadsheet and create a budget. Now we have a lot better technology in what we call integrated budgeting systems, where all of our information can be gathered and entered electronically by the manager themselves, and then that budgeting software can actually make adjustments as needed. So I mentioned earlier, what if the surgery department increased their volume by 10%? If that's going to affect other departments, then your budgeting software can automatically make those adjustments to those departments. And of course, there would have to be some type of notification to let that manager know why their budget was adjusted. But having those types of integration features can be very, very helpful in creating a budget. Adding an inflation rate, create your budget. Then you say, okay, I want to add a 2% inflation rate to my expenses. You can do that through a budgeting system, or you can pick and choose however you want to do that. You get real-time information. So once you put the information in, you can generate a budget immediately, see where you're at, and then you can go back and massage that budget however you want and continue to see the results of that. So I mentioned earlier, we're going to focus on a 12-month or annual budget. There are opportunities sometimes to create what we call continuous budgets or rolling budgets. This simply means that the organization continues the budgeting process month after month so that they have X number of months ahead already budgeted. So the organization might say, okay, I want to always have 12 months of budget ahead prepared. So each month they would have to add on an additional month. That's called a rolling budget, or continuous budget. We didn't do that. We focus more on the annual budget. And I think a lot of organizations do that. They focus more on that annual budget as opposed to a rolling budget. All right. So when we look at the budget preparation process, we're going to need some type of information to help us facilitate that information that we're going to enter on our budget. So if we're in an organization that has existed for a period of time, we're going to rely heavily on the prior years to help us identify what our sources of revenue are, what our expenses are, what amount are they, where are we at from year to year, and that's going to be very helpful for us in projecting our budget. But what if we're in an organization where we have no history and we have to rely strictly on our knowledge or our estimates of where we're going to go? And of course, that would only occur if you're in an organization that is new or an organization that has, for some reason, lost access to prior information. We call that zero-based budgeting, where we have no information to start from. And of course, that is going to be a lot less accurate than when you have some prior information to rely on in building your budget. Now, that's not to say you would look at that budget and say, okay, I'm going to follow that same trend, because there can be other factors that affect that. You know, right now we're in a highly inflationary economy over the last 12 months. Supposedly it's starting to ease. I don't know. I see some things that I'm kind of leery of believing that it is getting better. Some items continue to go up in price. I don't know about you guys, but you know, maybe that's not the case. But when we budget, we have to think about those types of items. And just because we were at X in the prior year doesn't necessarily mean we're going to be at X in the upcoming year. So we start with those numbers, and that allows us a good point where we can move forward in budgeting. When we prepare a budget, we are preparing a static budget. In other words, we're preparing our budget based on one specific level of performance. So the emergency room department says this is how many emergency room visits we're going to do next year. They're going to prepare their budget based on those number of emergency room visits. The lab department is going to budget based off the number of lab tests they expect to do next year. That's a static budget. It's based off a one specific level of activity. That's our starting point in creating a budget. Okay? You can't create a flexible budget without a static budget. So that's, you've got to have that. Is that to say that you can't go back and modify your budget? No. But it is going to be your starting point in creating that overall budget for the organization. Static budgets need to be realistic, however. You know, if you go into a static budget process and you over project your revenue or you under project your expenses, that's not a good thing, because you're going to live by this document for the next 12 months. So if you haven't done a good job, then that's going to come back later and bite you and cause you problems. So the static budget then is our starting point in the budgeting process. Once we prepare a static budget, we can then implement that, and we can adjust the items that need to be adjusted in our static budget to meet our actual level of performance. That is called a flexible budget. So, for example, if we prepare our emergency room department budget based on an estimated number of 500 visits by patients, and we end up at 480, we can't really take a budget based on 500 visits and put it up against the actual numbers for 480 and make valid comparisons. So what we have to do is we have to take that static budget of 500 and we flex it meaning we adjust the variable numbers in that budget to what they should be at the number of actual visits we have. So then we have a actual number of 480, and we have a budget that's been flexed to 480. So again, we build our flexible budget off of our static budget. So when we're creating the actual budget initially, it's going to be a static budget. All right. So let's get in a little bit into the process of creating the master budget. And again, this is going to be looking at the operating budget. There is a second type of budget we do called a capital budget. That budget is designed to plan for the purchase of high dollar capital, things like equipment, machinery, buildings. That capital budget is going to involve a lot more costly items. It's typically done separately because of that process, and the way that we go about creating a capital budget is different than when we're doing an operating budget, because most times when you solicit request for a capital purchase, it's going to greatly outweigh the actual amount of money you have available. So if you have $5 million worth of capital request and you only have $1 million to spend, you've got to have a way to whittle that down and decide where you're going to throw that $1 million. So the capital budget is a whole different process than the operating budget. So here we're going to be focusing on the latter. All right, so let's start out with a manufacturing company. So what you have on the screen here is you have a flow chart illustrating how you would go about creating an operating budget in a manufacturing facility. First thing you're going to do when you create a budget, or step one, is you're going to create your volume budget. And when I say volume budget, you're going to project the number of units or whatever that might be that's going to drive your revenue. So if I'm in the emergency room, my volume driver is going to be the number of patient visits. If I'm in the lab, my volume driver is going to be the number of lab tests that I do. So the first thing you need to do is identify what's driving your revenue or what's driving your sales. That way you can take that volume indicator and you can adjust it up or down to help you arrive at your sales budget. So your sales budget is simply the volume indicator multiplied by your sale price for that particular item, whatever that might be. So emergency room, number of emergency room visits, multiplied by the average price for an emergency room visit, that would give me my sales budget for a hospital, for the emergency department. So you've got to have a statistic in which to build your budget off of. That's why we call it a volume budget, a volume statistic, or a volume indicator. You pick what that is. You want to pick whatever it is that best describes how your revenue moves, what causes your revenue to go up and what causes your revenue to go down. So spend some time thinking about what that driver is going to be. Once you have that, then you can project your sales budget. So in a manufacturing facility, you're going to project how many units you're going to sell of the particular product or products that you're manufacturing. Once you do that, the next step is to produce those units. So I know I'm going to sell 5,000 units. So now I've got to produce those 5,000 units. So now we move into the production budget process. So the production budget process is simply accumulating your cost in order to produce the desired number of units. So if we're selling 5,000 next year, we probably don't want to produce just 5,000, because if we only do 5,000 and we sell 5,000, we're not going to have anything left on January the 1st of the next year. We're going to have to produce, and we're going to end up potentially having shortages, or we're going to run out of product. So we might say, okay, we're going to sell 5,000 next year, plus we want to have an extra 500 at the end of the year to get us into January. So we're going to set our production budget at 5,500, and that's fine. Okay, because you don't want to end up in a situation where You're just producing what you're going to sell, when production may take an additional amount of time. So the production budget then is based on the number of units that we're going to produce in order to meet that sales budget and to provide us a reserve. So you'll see that when we do that production budget, you guys should already know that the cost of a product is made up of 3 components: direct material, direct labor, and factory overhead. So in order to build the production budget, we have to build the 3 separate components to come up with that total production budget. So we build a materials budget based off the amount of materials that's required multiplied by the cost of the material to get our total budget. We do our labor based off hours and rate. And then we do our overhead budget for those costs that aren't captured as direct costs. So which of these can be more difficult to do? Well, it really depends on the type of organization you're in. For me, and the type of industry that I worked in, we put a lot of time into a labor budget. Now, we didn't create a production budget because we weren't making a product, but we still had to create a labor budget because that was well in excess of 50% of our total expenses. So in a production facility, when you create your labor budget, you have to figure out how many people do I need in order to produce the number of units that I want to produce in my production budget. So it requires you to do some time studies to figure out, for example, how many units can one person do per day, so on and so on. How many people work on this product? You know, what amount of time is required. So you have to do what we call time studies to figure out how many employees you need in order to meet that production target. And that can take a little bit of time. And I always tell business professionals that when you do time studies, meaning that you're observing the employees and you have a stopwatch in your hand and you're measuring how long it might take them to do a certain process or a product, make sure that the employee does not know that you're watching them. Because if they know, do you think they're going to work hard? No, they're going to slack so that you don't set their standard as high as it should be. So when you do time studies, you know, it has to be something you do from afar without the knowledge of that employee, because you want to catch them in a situation that they're normally functioning, okay, in creating those time studies. And you'll want to do multiple time studies of the same process. You know, the first one you might go in and it's a bad day. You have employees that are having a bad day for some reason. If you rely solely on that time study, then you may misinterpret your labor budget. You know, you may want to go back and do a third observation and a fourth observation over a short period of time and then average those numbers together to come up with your labor budget. So this is a very important budget, and it's very difficult to do when you think about it because humans aren't consistent. We have good days, we have bad days, we have days when we're more productive, we have days when we just don't want to be there and we're just getting through the day. So how do you budget for that? You can't. All you can do is create reasonable averages of taking all of those different components, putting them all together, and coming up with your numbers. So it's hard sometimes to budget labor. We'd like to be as specific as we can, especially if it's such a large component of our operating expenses, but we have to do the best with what we got. Now, if we had all robots, then that's easy. Okay, we could budget our labor pretty easily with robots, right? But unfortunately, not all businesses have that. We're seeing more robots in factories. I live very close to a Volvo truck plant, and they continue to add more robotic processes to their factory. So they have robots doing things like painting the cabs of the trucks or welding certain components on the truck. So when we have robots, we have pretty consistent volume output. Now, of course, robots could break down, but we probably want to figure that into our production statistic. But, you know, we're going to get much better production in terms of the daily output with a robot. But again, that's not usually the case, right? We have to deal with the human aspect. So once we complete those three pieces, then we're going to put that together and create our production budget. Now we know what our costs are going to be in those areas, and we know what it's costing us to produce a unit or whatever we're budgeting our sales on. So if I'm the emergency room, I'm going to know how much it costs me to take care of one patient in the emergency room. That's the equivalent of a production budget in a manufacturing facility would be, what does it cost me to take care of a patient in terms of material, labor, and overhead? Then I'm going to calculate my remaining monies after I subtract the cost of that product or service from the sale price, and that's going to leave me my gross margin. So if I say, okay, my average cost of creating of an emergency room visit is $10,000, that's what I charge. It's costing me $8,000, so my profit margin or my gross margin would be $2,000. So that leaves us $2,000 to cover our remaining expenses, and whatever's left over becomes our profit. So at some point, we have to also project all of the other expenses that we're going to incur as an organization. These are expenses that are not directly part of the production process. So here you've got a budget, what we call selling and administrative, or G&A expenses, general and administrative. So these would be all your costs that aren't part of the production process, that aren't captured in these three smaller budgets. So your IT staff salaries, your accounting staff salaries, your marketing costs, all of those things have to be budgeted. And really, when you look at the selling and administrative budget, it's a lot easier than trying to do a product budget, because a lot of these costs are pretty consistent from period to period. So you don't have a lot of change, for example, and you can many times be more flexible in what you budget in those areas. So you can decide how much money you want to spend on marketing. There's nothing that says you have to spend X amount. That's really up to you to see what fits into your budget the best. So once we figure out our revenue from our sales budget, we figure out our expenses by taking our production budget and adding our selling and administrative expenses. We can subtract that to get to our budgeted income statement or our profit for that particular department or that particular organization. Now, I make it sound kind of simple, but really it's not. This is a long process. When we build a budget, when we built a budget in our healthcare facility, we started this process in July, and we did not finish until the latter part of November. So you're looking at 5-6 months in order to get everybody completing their budget properly, getting everything compiled, and working through any kinks or making any changes that you need to make in order to arrive or meet your long-term target. And most of the time, those targets are given to you by your board of directors or your CEO, whomever, that comes out and say, okay, when we do our operating budget, we need to budget for $1 million in profit. So it might take us 3-4 times going back and revising this budget to get us to that target. So it takes time. It's not always an easy process in order to get to that final income statement. But that's our goal. Now, I will address the issue of doing a budget for a service company, and really that's easier, like a hospital, because we don't have to deal with a production budget, really, because we're not producing anything. Now, we could figure out how much it costs us to provide the service from material, labor, and overhead, but we're not producing anything per se. So we could actually skip a production budget and go directly to the labor budget, since that's the biggest part of our expenses, and then also budget for your other parts in your general expenses instead of worrying about a production budget. So that's what we did. We did not do a specific production budget. we did our sales budget, and from there we did our expense budget, including the wages and salaries budget. So we kind of bypassed this piece and built in all of our expenses down here. This is just an example of the budgeting process. This is not saying you have to do it this way. That's really up to an organization. I've never worked in an organization where they did the same thing that another organization did, that the budget process was identical. Never been in that situation. So you have the flexibility to create your budget the way that works best for your organization, that fits best within your system, your structure, the product or service you're producing. So this is just a general overview of what the budgeting process looks like. All right, so what do we do when we get that operating budget finished? We get that budgeted income statement. So now we have a income statement where we combined all of our departments together and we are reflecting a net income. So again, if we meet our target, we're okay. But if we aren't meeting our target, we may have to go back and revise. We might go back to each manager and say, okay, you're going to have to cut 5% of your budgeted expenses out of your budget so that we can meet our target. And that's where things can get a little dicey sometimes, obviously. That's why I mentioned to you budgetary slack. If you don't have any slack in your budget and you're asked to cut 5%, then it can be somewhat painful. So this can take a little time. You know, it could be that one department may not be able to cut 5%. There's nothing there that they can actually cut. So then you have to look at other ways to make up that difference. So whatever it takes in that process, you have to do that in order to reach your target, or you have to be able to prove that that target is not attainable. There's no way we can get to $1 million. No matter how you want to do it, there's no way we're going to do that. But at the same time, you have to be able to support that statement to your senior management or whomever, so that you don't look like someone that's just saying, well, we can't do this because we don't think we can do this, so no worries. So we have to be able to support whatever we do in this process. Once we take this operating budget and this income statement, from there we can create some of our other pieces. We can create our cash budget. So we know how much cash is going to come in from our revenue. We know how much cash is going to be needed in order to pay our expenses. So we can calculate our cash needs and we can figure out how much cash we're going to have left over each month, if we have anything left over. Or maybe we have to save money in one month to get us through the next month. So the cash budget allows us to project that into the next 12 months. And the capital budget may be significantly affected by your cash budget, because where's the money going to come from to buy your equipment and your buildings and all those big dollar items? They're going to come from the cash that you're generating from operating your business. So that can be a major driver in how much you budget for in your capital budget. We can also project our cash payments budget. So we have to make sure that we have enough cash available each month to pay our expenses and to pay any debt payments that we have. And we might say, okay, each month we want to put back $50,000 in our savings account, so we can build that into our cash budget. And that helps us plan accordingly going forward, so that we know approximately how much money we need to have available. And if we were to have a shortfall, where are we going to make up that difference? So if we know that 6 months in advance, instead of 6 hours in advance, makes life a lot easier in managing your cash. You know, no company wants to be unable to pay their debts or be unable to make their payroll. That's not a good thing in terms of your employee morale and your image in the community if your paychecks bounce. So not a good thing. Okay. So by completing that cash budget, that's really helpful. And as I said earlier, that leads you into the capital expenditures budget, but that is not part of the operating budget. It's a totally separate process. Now we do both at the same time. They run concurrently. So you're going to be doing your operating budget, and you're also going to be doing your requests for capital budgets at the same time, but they're going to be handled separately. From the income statement and the cash budgets, we can create our balance sheet. We can create a pro forma balance sheet. We can figure out, okay, based on how much cash we're going to have, how much are we going to spend on this, how much are we going to have in accounts payable, how much are we projected of that sales we're going to have in accounts receivable, how much inventory are we going to have that we have to manage as an asset, what other assets are we going to have, are we going to take out any liabilities? So we can project that by creating a budgeted balance sheet. So we start with a single volume statistic. And by the way, each department can use their own statistic. We start with that statistic, and then our end goal is to create these pro forma financial statements, the income statement, cash flows, and the budgeted balance sheet. So we have all of our statements available that we can use in planning going forward. So that's the goal of the budgeting process when we do it. So I've spent about 45 minutes trying to explain to you a process, as I said earlier, that takes months to do. Do any of you have questions on what I've talked about? Did I answer your questions? Emelina, you were asking about the budget for a service company, correct? So did I address your questions there?
I believe so. Yes.
Okay, yeah. So budgeting for a service is a little bit different than budgeting for a product, because you don't have to do a production budget. You're budgeting based off the service. So the biggest component, as I mentioned, of a service budget is your labor, because services are predominantly labor, taking care of a patient, building a house. Of course, you have other costs in that, but labor is a big part of that. So you most likely will spend a lot more time on your labor budget in a service-related industry than you would in a factory. This is just kind of my observation. Not that one is more important than the other, but it's just a matter of how much time it takes to pull all of that together. All right, so that is an overview of the budgeting process in a nutshell. So again, if you're not skilled or you're not experienced in creating budgets, try to get some experience doing that. It will do nothing but enhance your ability to be a good manager. Learning what the financial statements are, learning the terminology, learning how your department interacts with other departments, and being able to talk the budgeting talk. I spent, I would pick one Wednesday out of each month, and I would have a luncheon. I would provide lunch, and I would invite all of my managers to come, and I would always focus on one topic related to financial statements or budgeting, something that I could use to educate my managers on that component of their responsibility. And I found that very helpful to them, because that was something they could apply and help them better understand. And I think for the most part, they really enjoyed that as well. So take advantages to educate when you can also. All right, so if we look at our Canvas page, this week your activities are pretty consistent. You have your discussion board to complete. I will get those graded in the next few days for week 1. Just make sure you're doing an initial posting and you're doing your follow-up postings, and all of your postings are substantive, meaning that you're adding new content to every posting that you do. Don't just say, I agree with Sam. That's not substantive. So you should be building on that content as part of your follow-up postings, or you're going to have points deducted because you did not do that. So be creative, be thoughtful, use your personal experience, that you have. your personal ideas in your follow-up postings as well. So you're going to be doing your discussion, you're going to be doing your homework problems on Connect, and you're going to have your quiz on Connect. I know the pulse surveys aren't graded, but if you can take time and do those, that would be fantastic. It just kind of helps me see how the class is going. So I would ask if you can to help me out in that aspect. All right, so that's kind of where we are. So no surprises. That's what we need to be working on through the 15th. And again, as I mentioned in the first live session, if something comes up, you know, that's not usual, that you need a couple of extra days to work on an assignment or a quiz, that's fine. Just let me know. You know, I need a couple extra days, whatever may be the case, and it's not going to be a problem as long as it's not something we're doing every week. So I can be flexible in that area. All right. So next week, we're going to get into a little bit further on how we use that budget in decision making and in managing different costs. So we'll get into the flexible budgeting process and analyzing variances. Variances refer to a difference between your actual number and your budgeted number. So you budgeted for $5,000 in salaries, you actually paid $5,200. So you have a $200 variance. So our responsibility then would be to find out why we have that variance, and two, figure out what we can do to get back in line with our budget. So we have to be able to learn those tools, learn how to identify where we have those opportunities, I call them opportunities, to get us back on our budget path. So we'll get into that area next week. All right, last call for questions. Okay, I hope that each of you guys have a wonderful week. And if anything does come up, contact me. I'll be glad to help. And I'll plan on seeing you then next Tuesday for our next live session. Have a great week.
Professor.
Bye.
Thank you.